When it comes to investing, there are an infinite amount of ways that you could go about building a portfolio, but for this video, I'm going to analyze why most investors fail and break down the difference between gambling in the stock market, which I mainly refer to as stock picking, where there is a chance for very high returns, but that also comes with very high risk. Or you could play it safe, which pretty much means you rely on investments like bonds, where you'll get low returns, but that also reflects why you'd have nearly no risk. And then the last type of investors are builders that invest into assets that are likely to develop their true underlying value over time, which there's definitely a calculated risk you're taking here, but there's also the opportunity for strong returns on your money. Each have a completely different tolerance when it comes to the risk to return potentials, but the fact that new reports find that almost 80% of active fund managers are falling behind major indexes, 85% of actively managed funds failed to beat the S&P 500 over a 5-year period, and if we look over 15-year periods, that number increases to be 92 to 95% of them that fail to beat the market. Not just that, but data shows that an estimated 70 to 90% of day traders lose money, where you can see further data showing the majority of investors lose, specifically when trading. Knowing that, my name is Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, before I explain why most investors fail and which one truly wins, let's go over 3 types of investors, starting with the gamblers. Now for this, I am mostly referring to those that actively trade stocks or other types of securities that fulfill the idea of potentially getting super high returns, but at the cost of super high risk. Interestingly enough, CNBC calculated how a $10,000 investment made 25 years ago into a handful of companies would have turned into millions of dollars. In fact, if you bought $10,000 of Nvidia 25 years ago, you would now have $32 million, or Monster, you now have $11 million, and you probably know the stories as someone who bought Apple early on. For this case, that would have turned into nearly $4 million. Now don't get me wrong, investing into individual stocks definitely has their time and place for investors, but many fail to understand the calculated risks associated across their entire portfolio if not handled properly. The reason this is crucial to understand is because not all stocks are likely to do well, and in fact the odds are super low, and the data shows that over 5, 10, and 20-year rolling periods, over almost a century of time, it reveals that over a 5-year period, only 35% of companies survive and outperform the market. Over 10 years, that number decreases to 29%, and over 20 years, that makes it go down to 21%, meaning that only 1/5 of the companies you buy based on historical data will survive and outperform the market over time. And not to mention, but over 20 years, only about 48% survived, with the rest being delisted, and that of course will kill your potential return significantly on your entire portfolio. And so these odds make up the reason for a popular real-world example that shows how a blindfolded monkey throwing darts at a financial newspaper could select a portfolio that would do just as well as ones carefully selected by experts. All in all, if you are an overly aggressive investor and take on too much risk trying to outbeat the market, the odds of actually doing so are very slim, and it's why one of the wisest investors of all time, Warren Buffett, says how a low-cost index fund is the most sensible equity investment for the great majority of investors. Knowing that, this now leads me into discussing the second type of investors that are builders. When I say builders, I like to refer to investors that understand the importance of value and growth of appreciating assets, and understand that true growth with any company takes time to achieve. Now, the example I'll reference here is because Warren Buffett says the best thing to do is buy 90% in an S&P 500 index fund. And if you don't know what that is or haven't seen any of my previous content, the S&P 500 pretty much reflects 500 of the largest US-based companies and pretty much resembles the broad scope of the US economy. And so by investing into it, you are essentially betting that the people building and developing the country will continue driving growth over time, which that long-term growth would directly reflect your investment if you bought the S&P 500. But understand that just like a builder of a home, there are many steps you have to take slowly, and at any time you may have to go back and fix something. So just like the US economy, there are times where things could go wrong wrong and the markets decline, which causes volatility on your investments. So to be a true builder in the markets, you have to understand it is not a get-rich-quick type of game, but rather that the best builders are the ones that allow time in the market to do its justice. You see, the longer you allow your investments to stay in the market, the longer you allow the builders to continue developing the economy, which, as I said, if you invest into the S&P 500, that would directly reflect the returns on the investment if you were to buy it. This now explains why the word diversification is so important, because the ability to allocate your investments with a calculated risk into the right areas is crucial and can easily make the difference of having a successful retirement or not. In fact, diversification when it comes to builders refers to understanding how much they need for short-term goals using things like fixed income securities or high-yield savings accounts to the ability of storing away long-term cash and diversifying it into strong assets like an S&P 500 index fund. So to sum it up, the goal when it comes to investing in the markets is to achieve strong returns on your money while reducing the downside risk of financial hardship. Now, being a true builder may seem confusing or super difficult, but fortunately there are investments called index funds that allow you to buy hundreds to thousands of different investments all within one purchase. This is exactly how the S&P 500 is structured as an index. You can buy it as an index fund, and that is exactly why Warren Buffett said this is the best thing for the great majority of investors, specifically the builders that are looking to optimally invest for a safe yet successful retirement and even financial freedom before then. I will say, if you feel overwhelmed, I've also created many other videos on these topics, and it's the reason I just started a new startup called InvestLane to help others save and invest wisely for their future. But for those concerned with risk and are nervous to invest, you have to understand the third type of investor is those who play it safe. When I say play it safe, this is very much the opposite of the gamblers, because play it safe investors are nervous to even touch the volatility of the stock market, which may be due to a previous history of investing during a market recession. And so they solely use things like high yield savings accounts and fixed income securities like bonds to ensure that they don't lose value on their savings. But the matter is, over years of doing this, you may average 4% of a return per year, but with inflation averaging around 2.5%, it doesn't lead you with much real growth, and that doesn't even include tax that you would have to pay on income or gains that are triggered. And that also assumes that you place your money in the right areas, because if you let it sit in a savings account, it could actually be costing you much more than you think, and it's why I just recently created a video on this topic. But understand that there is a reason that these products exist, because they can be great tools depending on your short-term goals, age, and overall position. But when it comes to using high-yield savings accounts and fixed income securities, you should expect to see low returns over time, but the benefit is that you have nearly no risk. But like I said, the problem here is that with low returns over many years, you're not going to build lasting wealth, because say you have $100,000 today, but you put it all in a 30-year fixed income security, in 30 years, that will be $324,000. But if you balance things out and average an 8% return instead, that alone offers an end portfolio worth $1 million. All in all, every percentage increase that you can generate can have a huge impact on your future due to what's called the power of compound interest. But before I discuss more on that and real-world statistics, let's officially go over why most investors fail. To start this off, understand that most investors fail not because of the amount of income one earns, but because of behavioral decisions that prevent a true foundation to be built. You see, a janitor and prior gas station attendant who was based out of Vermont is a great example of this, where he amassed an $8 million fortune and left most for his library and hospital, but the reason was due to smart saving and investing habits. He proved the point that you don't need to earn a massive paycheck to become a millionaire, and that you can reach the 7-figure mark on a modest salary. But as I mentioned earlier with the gambler investor example of taking on too much risk, having too much confidence and greed can lead you toward chasing hot stocks, trying to time the market, and assume that things will work out in your favor. While this has worked out for some, the odds are not in your favor, especially for those thinking to bet your life savings on a hot stock or meme coin. It may sound like a good idea, and you might be told it's going to do very well and work out for a while, But once a market crashes, many times that can lead you into great pain. Where on the other hand, play it safe investors also fail to have enough at retirement majority of the time unless they have an extremely high paying career and save well. But the point to get across here is that having too much fear to step into the market is actually letting factors like inflation eat away at your money and a significant opportunity cost that could be from having other investments give you higher returns if you were to ride them out long enough. All in all, if you take on too much risk, your retirement is an actual gamble, and if you take on too little of risk, you likely won't have enough at retirement to last the rest of your life. The truth is, most investors fail not because they picked the wrong stocks or specific investments, but because they became the wrong type of investor. So what type of investor are you? Feel free to leave a comment below on your thoughts, because at the end of the day, everyone invests differently. Now, understanding why most fail is important, but even more important than that is to understand why builders win. The first reason why builders win is because they have a long-term vision with the mindset focused on decades rather than days or months. Builders also don't panic in downturns or get greedy on market highs, where they also rely on disciplined strategies through a planned system rather than going based on their gut feeling. And lastly, the steady approach being a builder allows time to do its magic from the power of compound interest. I touched on this earlier, but all that means is that as you have your money grow over time, that growth compounds to making more and more money the longer that you invest. And so from the play it safe investor example of earning a guaranteed 4% per year, let's make it a bit more realistic and say you had $10,000 today and let it sit for 30 years. By that 30th year, your investments would be worth $32,000, and that last year alone, it would have only grown about $1,200. But if it were 8% by the 30th year, your investment would reach $100,000, and in that last year alone, it would have grown just over $7,000. But if we change that to 10%, which is still realistic, that means you could end near $174,000, with the last year alone growing almost $16,000 more than what you initially started with at $10,000. But the craziest part of all to understand and take forward is that if you become a builder and consistently build up your portfolio the right way, and let's say of all the accounts you use, like a 401k, HSA, or IRAs, to name a few, if you totaled $750 per month, that would lead you to over $1.7 million. But notice how over time the interest in red, which is how much the portfolio goes up each year, the amount increases significantly the longer you stay invested. And interestingly enough, the last year alone, your portfolio would have grown $156,000. To emphasize how valuable time in the market is for builders, say that you were to add 10 more years to this and do it for 40 years. Say you're starting at age 25, which means by the time you're 65, you would have $4.6 million, easily enough to last the rest of your lifetime. And above all, notice how each year, once you pass the 30th year, you are growing the portfolio more and more each year, where by the 40th year alone, your portfolio would have grown over $400,000 in that 1 year. The best real-world example that is a complete outlier, but it shows the truth on how well compound interest can work for you when you achieve high returns over time, is when looking at Warren Buffett's investment career, where he started super young and consistently invested into the best companies possible, succeeded with his decisions, averaging a huge ROI over time, and after the second half of his lifetime, his net worth skyrocketed, and it now seems like every year he grows his portfolio billions of dollars. With a B. This is a huge reason why I encourage others to start investing as soon as possible, and why I highly recommend an index fund like the S&P 500 or a total stock market index fund, because they allow your money to have great diversification while still giving you the opportunity for strong potential growth and reduced risk over time. Now, I've created much more content similar to this that I'll have linked in the description below if you want to check it out. And I'll also mention, if you want to check out some of the top investing platforms or high yield savings accounts, I'll have direct links to them in the description below. End of the day, I want you to do what's best for your finances, but do know that depending on the ones you choose, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.